Hey everyone, welcome back to Corporate Decoder, the place where we pull back the curtain on Wall Street's biggest players. Today we're diving into Elevance Health's latest filing, and let's just say they're giving us quite a peek under the hood, especially when it comes to their future earnings. If you love getting clear, no nonsense insights from these dense corporate documents, make sure you are subscribed. We've also got a fantastic community over on Discord. The link is right down in the description if you want to join the conversation. So Elevance Health, you know them as a major player in the health insurance and benefits world. They're the folks behind brands like Anthem. Today we're looking at their current report, specifically what they expect for the rest of 2025. The most interesting part here is what their top brass are telling investors over the next week. They're not just giving a vague outlook, they're reaffirming some pretty specific numbers. Think earnings per S-share, which is basically how much profit they expect to make for each share of their stock. For the full year 2025, they're sticking with their forecast of about $24.7 in earnings per diluted share. Now, what complicates that number is something they call net unfavorable items. It sounds a bit scary, but they're saying about $5.3 of that total earnings figure is due to these specific less than ideal things. When you strip away those unfavorable items, their adjusted earnings per diluted share are still expected to be around a solid $30. This is crucial because it gives a cleaner picture of their core business performance, separate from one-off or temporary financial hits. They're also making it clear this doesn't include any new surprises beyond what we saw in their third quarter earnings of 2025. Beyond just profit, they're also confirming their guidance for the full year benefit expense ratio, which is holding steady at about 90.0%. In simple terms, this ratio shows how much of the money they collect in premiums goes towards paying out medical claims for their customers. A 90% ratio means they expect to pay out 90 cents for every dollar they receive in premiums for medical services. That leaves them with 10 cents to cover their operating costs, invest in the business, and hopefully turn a profit. Keeping this ratio stable often means they have a good handle on their costs and are predicting healthcare usage trends accurately. Now, why should you care about these numbers and how they're talking about them? Well, this is where management shows their confidence, or lack thereof, in their business. When they reaffirm guidance, especially with details like adjusted earnings, it suggests they feel their current strategies are on track, and they're not seeing any major clouds on the horizon that would force them to lower expectations. They also mention that these expectations are based on things like market conditions, how well their operations are running, the rules and laws that affect the healthcare industry, and how their guessing costs will line up, especially when it comes to paying for medical bills. This is a really important point. It means behind these neat numbers are a whole lot of educated guesses about the future. And if those guesses are wrong, then the actual results could be quite different. And speaking of risks, the document also lays out a whole lot of potential storm clouds. They're very upfront about the many things that could go wrong, and believe me, it is a long list. Things like changes in healthcare laws, which are constantly shifting, could seriously impact their business. Also, cybersecurity threats and data breaches are a huge concern for any company, especially one that handles so much sensitive personal health information. Anything that causes them to not maintain the availability and the accuracy of their data could lead to big problems. Economic slowdowns or market volatility are also mentioned as major risks. This can affect everything from how many people can afford their plans to how their investments perform. Competition is another biggie, as is the complex world of government programs like Medicare and Medicaid, where rules can be tricky and compliance is a constant challenge. Any slip up in those areas can lead to fines or loss of business. Then there are the relationships with doctors and hospitals. Elevance Health needs to make sure they can work with healthcare providers in a way that keeps costs down, but also ensures quality care for their members. If they can't get good deals with providers, their own costs go up, which eventually affects their profitability. You've also got the day-to-day risks of actually providing healthcare, pharmacy services, and other related products. This can include things like medical malpractice claims or issues with their pharmacy partners. They're essentially saying that the entire chain of delivering healthcare services has its own set of potential pitfalls. And for us investors, they touch on their ability to buy back their own stock or pay dividends. This is usually a good sign when a company can afford to do it because it shows financial strength and confidence in future cash flow. However, they tie this ability directly to their cash flow and earnings, reminding us that these shareholder-friendly actions depend on the company actually performing well. Finally, they mention the risk of a downgrade in their financial strength ratings. Think of this like a credit score for insurance companies. If their rating goes down, it can make it more expensive to borrow money and can signal trouble to customers and business partners. So, let's look at the big picture here. Elevance Health seems to be navigating a very complex and regulated industry with what appears to be a solid plan for 2025. They're projecting strong adjusted earnings, which indicates their core operations are healthy. The reaffirmation of their benefit expense ratio suggests they're managing costs effectively. However, the extensive list of risks they highlight is not just boilerplate. It underscores the volatile nature of the healthcare sector and the constant vigilance required from management. What is my take? Elevance Health is showing discipline in managing its core business and is communicating its outlook clearly. The focus on adjusted earnings is a common practice to showcase underlying operational health, and their guidance seems robust if those underlying assumptions hold true. The biggest opportunities lie in their ability to innovate and adapt to the ever-changing healthcare landscape, particularly in navigating regulatory changes and delivering value to consumers. The risks, as they themselves point out, are numerous and significant, ranging from economic downturns to unforeseen healthcare crises for investors. It is about weighing that solid operational performance against a backdrop of inherent industry volatility. Alright, that is our breakdown of Elevance Health's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.